From 5 CR to 22, what's your investment strategy?
I call myself a techno funda investor. As I mentioned, I have fast growth cyclicals and special situations. My space, I would say hunting ground is less than 10,000 crore market cap companies.
What resources should I go to if I want to read more on that?
So the idea is to read the investor conference calls, the investor PPTs, try to figure out which are the sectors in future the growth will come.
What are the top green flags and red flags to look out for in a company?
The company is making a lot of money in terms of profits, but in reality, they're not making a lot of cash flows.
What is your advice to a new investor?
Don't start concentrated. Start with like 30, 40 stocks. Slowly bring it down to is an ideal number.
Hi Shubham.
Hi.
Welcome to Power Pioneers. So let's start with Shubham, your early journey, your career and family.
So basically, I'm a computer science BTech pass out in 2012. I basically started my job in an IT company in Noida. Thereafter, I stayed there for almost 6 months, and then I moved to Hyderabad into basically Amazon. Till 2016, I worked in Amazon, and then basically I had a chance to go to the US in Amazon itself. And so, yeah, 2016 to 2019, I was in the US. And then 2019 is when I thought, I'll just quit and I'll try something of my own.
Great. So, from 2012 to 2019, like 7-8 years of corporate career, would love to understand, in terms of, and especially for, all the people in the tech out there, how did your salary grow over the years?
So when I joined in 2012, my first company, even though the CTC claimed to be 10 lakh, I used to get 50,000 rupees a month. But anyways, not because of the money, but I was a software developer, and that was a software testing job, which I did not want to do. So I quit after 6 months. Second, when I joined Amazon, the package was very similar. It was, I think, 11 lakh. I had a salary hike. I think the package was 18 lakh, I think. That was in early 2015, I think. Yes. So when I went to US, I think it was around $100,000. And I do not remember how much I used to exactly make. But yeah, that was the CTC. But the taxes in US are much higher. Yeah. So that was the salary progression. And then by the time I was into 2019, I think it was closer to 170, 180. Okay. $1,000 is what I was making.
Got it. Very interesting. And so we'll probably divide it into chapter 1 of your life, which is pre-2019, and chapter 2, which is, the one that you are currently leading, which is beautiful, being financially free. So let's double click on the first part, which is, your career, early career, and, moving to US. Having a stable corpus to be, sort of able to hang up your corporate boots, it requires a lot of investment planning and, financial, like you would have to make certain financial decisions. What was your approach towards investment during that early phase of your career?
To be honest, I was not very aware. So the only option I had was, okay, I have saved up some money, let me do an FD. Okay. So I realized the importance of money, but I was not knowledgeable enough to, make the right choice. I was not even aware of mutual funds, nothing like that. And over time, in 1 or 2 years, I started enjoying the process of investing. Even though I did not have any knowledge, to be honest, I was just picking some big companies like a Nestle and like all the good companies, right? But still, my journey never started with mutual funds. So I never got into mutual fund. I just started with direct stock investing. Okay. I had to wind down because in 2016, I had to go to the US. Around that time, my journey was like, okay, what were the big investors doing? Typical process that a lot of people who start out do that. But then a lot of time it doesn't end well. And I think the same happened with me because of the tax implications and all that. I closed down the Demat account. Okay. Because it was tax complication. I could not operate it from the US and so on. So I had to create another account. So I basically got the confidence, and so I put money into 5 stocks. I did not diversify, and so there was this one stock which was like 25% allocation out of those
Okay.
5 stocks, and that thesis that I had did not play out as expected, and it tanked, and I lost, I think, a few lakh rupees in the process. Basically, that was a wake up call. After that, I started reading books. I started diving deep, how it works, all the tools, exploring everything, and over time I started enjoying the process so much that by 2019 I was like, I want to do it full time.
Great. So, you said that early on in your career, you had most of the allocation in FDs. So, what was your portfolio split like back then?
So I would say initially when I started out, it was like 5% direct stocks and 95% FDs. But by the time by 2017-18, I would say around 25-75. So 25 stocks, 75 still
Major
FDs.
was still FDs.
Major was still FDs, yes. I was not a very good risk taker, to be honest. So by being in the process and talking to people, I developed it over time.
Okay.
And now I'm almost 98% stocks and 2% cash.
Oh, wow. That's such a like 360-degree change
That's a 360
from
degree change,
when you
yeah.
started.
And that is true.
Right. I also want to understand in terms of your savings or investing mindset, right? I think the salary grew and it grew exponentially when you shifted to US. What percent of your salary were you saving back then, and how did you maintain that savings rate or increase that savings rate? Because I think one of the things that's very underrated is lifestyle inflation. I think when we start earning more, we also want to spend more. But how did you control that? Because you were able to build, such a big corpus in a short time.
So for me, when I went to US, I had a clear goal that I'll come back in 3 years.
Okay.
I lived a very frugal life there, almost 80% saving.
Oh, wow.
I mean,
That's
that is
huge.
combined for me and my wife.
Yeah, of course.
Because both of us were earning. The rest of the 20% was rent, which you cannot avoid.
Got it. And what you mentioned about the split, right? Is that the combined portfolio for you and your wife?
Yes, that is the combined. Yes.
Okay. And is the investment strategy similar for you and your wife? Like, how do you manage expenses or like investments?
I think so. For her, she's not into finances.
Okay.
So now my strategy is, so whatever she earns, I just buy a house and I just pay the EMI for that house using her salary.
Okay.
So house expenses plus EMIs, her salary is done. And my goal is whatever saving is there to just compound it.
Got it. Very interesting. I'll come to this phase too. So at the time when you decided to come back to India, I'm also curious, why did you decide to come back to India? And second, what was your corpus back then which gave you like sufficient confidence that, okay, I can, sort of give up on this corporate job?
The number I had in mind was, I think at that point was 4 CR.
Okay.
When we actually hit 4 CR, I did not have the courage. I was like, no, I think I don't have sufficient. So let me work a few more months. So after 3 years, I got my visa extended and stayed there for another 6-7 months.
Okay.
So it was almost 3.5 years, so that I could get at least 1 CR more. So it hit 5 CR, and then I was like, I think now it is good enough. The thought process was that at least for 2 years, I can take a break and try something. If it doesn't work out with IT, you can take a 25% cut and then you can always go back to job.
Just curious, and I want to double click on stocks, as an asset class, and that's where you are primarily focusing now, even today. What's your framework to select stocks in both Indian and US market? I'm also curious to understand, is there a difference when you evaluate, say, Indian companies versus US companies?
The only difference is that in India, the market is still slightly less competitive than in US. In US, the information arbitrage is almost gone. My process is simple. I invest in fast growth companies, and because you always make money in percentage and not in absolute, right? So my space, I would say hunting ground is less than 10,000 crore market cap companies.
Okay.
So
Small mid
companies, yes. And that is where majority of my portfolio is also invested. And then I have another thing that I do, which is cyclical investing.
Okay.
Which is basically, a lot of these, I would say, commodity, non-branded things. Like, for example, iron, steel, paper, any commodity, right? So they have cycles.
Okay.
In a good period, these companies, their profits revert to mean. So they go up, they go down. And these cycles are generally 2-3 year of positive cycle and 2-3 year of down cycle.
Okay.
I invest in these cyclical companies and I try to time the cycles. And that happens because in this commodity company, nobody has any edge. And so when there is a bad phase, half the companies close down because they don't have any
Right.
edge, right? And when the good demand cycle comes, whatever is remaining make a lot of money. Right?
Okay.
And if you are able to time it, the remaining guys will make a lot of money. And the third strategy that I use is called special situations.
Okay.
Yeah.
What does that mean?
Special situation is an investing category where you basically focus on events. So, for example, you have a company, right? And you have two verticals. At one point of time, you become so big, and now both of these verticals are now self-sustaining, right? And then you decide to demerge the company. You say, okay, now they are two separate entities. So when multiple companies are combined in a single entity, the investors do not know where to invest because some people are only interested in your cards. Some people are only interested in your education or podcast arm, right? So you will not be able to find the right set of investors who want to invest in you. So the overall value remains slightly diminished.
Okay.
And when you break it up, right, every company gets the right set of investors, people who are really interested in just that business and not want to invest in the other business. And so a lot of times this results in value unlocking. Like I've seen companies gaining 100 to 200% just because of value unlocking. So these event-based investing is called special situation investing.
Got it. Interesting. And all of the things that you mentioned, right, they require a lot of researching, right, to know what's happening and timing the market, right, specifically in cyclical and
Yes.
special events also, you always need to be on top of the news. So
Yes.
how were you able to do this with the job in
No, I was not able to do it with the job. Anything which is very hard to do, I would say people who are in active job should ideally avoid because there is a high risk involved. And this is all discovery in the last 4 or 5 years after I quit my job. And the thought process was that with growth stocks, there are phases when the valuations become so high because the market is in such a frenzy. It becomes very hard to find good companies growing very fast. And even if you find the valuations are crazy, right? And then you don't make money even if you find a high growth stock because ultimately valuations are very important.
Correct.
So I thought, okay, what could I do? So I figured out there's something called special situation investing. And then there's an author called Joel Greenblatt who has a 50% CAGR in the last 10 years. So I read the book, I started reading, and then over the last 3-4 years, I kind of picked it up.
Got it.
So yeah.
Interesting. And I, particularly for the audience, most of us are still working. For the first part, like the first strategy, which is, picking up the high growth stocks, what's your framework to select? Like, are there certain metrics you look at from a company perspective?
The idea of high growth investing is that you basically invest in companies which are growing obviously very fast, but not just their sales, but also their profits, right? I have realized is that you do not make money in the absolute numbers. You make money when you ride the journey along with the promoter. So for example, a lot of times people say that, this is the PE of this company is 100. It is a 100 PE company. And then for people who do not understand PE, it's a price to earning ratio, which basically means to value the company. And so people say it is very expensive. But then if a company is growing at a 100% growth rate, right? 100 PE is cheap for such a company, and the market is very efficient, and whatever is already known that gets priced in very quickly, right? So you make money on what is not in the open yet.
Okay.
Right. So the goal here is to read as much to figure out which are the companies which will grow in the future rather than which have already grown. The idea is simple. When the growth phase is going on, the stocks go up like crazy. But as the growth slows down, for example, 100% growth companies become a 50% or a 30% growth companies, the valuation that the investors are willing to pay significantly fall. And so even though people think that in growth companies you do not have to time it, there is still some amount of timing involved because if you are very late to the party, when the companies deliver very high growth, you do not end up making money. Yeah. So the idea is to read like the investor conference calls, the investor PPTs, try to listen to the management, try to understand the sector, and try to figure out which are the sectors where in future the growth will come.
Got Got it. So, like two questions here, right? One is on what resources should I go to if I want to read more on that? And second, there are like thousands of stocks out there, right? How do I filter it?
So any company that becomes big or is growing very fast, right? A lot of time, for example, promoters or the best person who knows the most about it is the owner of the company,
Correct.
right? He will do some actions. For example, he might buy the stocks of his own company, right? That could be one signal. You need to have the curiosity to understand, okay, why is he buying? Okay, what is going on in the sector, and then correlate, right? Or there could be like other triggers. For example, a stock, it was always a dud. It never performed. Why is it suddenly rising? These are some of the signals, and there are a lot of them. So you have to be on your toes to figure out such companies.
Got it. So, as I understand, right, get the signals and sort of connect the dots and see if that's the right reason behind, stock going up, and then double click and then sort of pursue that company.
Yeah.
But my bigger question is, which company should I keep an eye on? Are there certain tools that you have used which help you to shortlist this?
There are a lot of tools. For example, Screener is the most widely used tools now. I use it a lot. Then there is another one called Tijori Finance.
Okay.
Very interesting tool. They give you a lot of these company level insights.
Okay.
They collate a lot of data. They tell you about the prices of a lot of commodities if you are into cyclical. Then obviously you have charts. So if somebody was to come to me and tell me I will only give you one information, and which is that one information you want, I would say just give me the stock chart, because at the end of the day, markets are efficient, right? And every event that is happening, every news that is happening, somebody is buying or selling a stock, and the stock is basically reacting to that. And so just by looking at the chart, you can actually tell whether some good things are happening to it or bad things are happening to it.
Okay.
These kind of tools, yeah.
Okay, interesting. Since you mentioned charts, I'm always curious, right? Sometimes, and especially in this frenzy and the bull rally, right? Maybe stocks keep on going up, right? But somewhere I feel if the fundamentals of the company are right, then it will test the time and ups and down, because you mentioned charts are the most crucial part of assessing a company. Would want to understand this fundamental versus technical. What's your strategy in terms of stock picking? What do you
So
prefer?
I call myself a techno funda investor.
Okay.
So I would not just invest based on charts. Charts are generally for screening. So I generally look for patterns where I have not done well for a long duration of time. So the charts generally look something like this.
Okay.
It keeps falling, falling, falling. Then it's like, I don't want to fall anymore. I want to go sideways. Then for 1 or 2 years, it will go sideways. Then it will start going up. So in the cyclical stock, it is a typical cycle that plays out. When the bad cycle is there, the stocks are falling. At some point, enough players have exited the businesses that now the demand and supply in terms of the product that they are selling is equal. So the prices of the commodity are neither going up nor going down. And so it same reflects in the earnings of the company, same reflects in the stock prices of their company.
Okay.
And then there will be a phase, then suddenly a demand comes and then the price will start going up. So I look for charts where this pattern is happening, and I try to go and see where is the cycle in those companies. There are like thousands of commodities.
Right.
I cannot track everything, right?
Yeah.
So you have to be smart enough to focus your energy into places where,
Correct.
yeah,
Short listing is the key part. I think there's so much data, so much resources out there.
Yeah.
Going to the right resources and the right data points
and
is.
that is just for cyclicals. For other stuff, it might be a different strategy.
Okay, got it. I think previously you were mentioning around 2019 your portfolio was 75-25. And then ever since that, it's almost 98% in equity. You didn't mention real estate, but now that you were talking about it, what's your take on, do you consider it as an investment? What's your take on real estate?
Yeah, so I'll tell you, when I started this journey, I had a plan. And in that plan, I basically had a lot of diversification.
Okay.
Where it was like I also had gold, I had real estate, I had stocks, I had mutual funds, everything. But then at some point within the last 3 years, I realized that after you cross some threshold where you are like, okay, now what is the worst that can happen? Right? Just as an example, if your corpus is 10 CR, right? What is the worst that can happen? It can go down to 5 CR maybe, right? It won't go down to 0, right? And if you're willing to absorb the volatility and you believe in the process, then you can take slightly bigger risk in order to get a higher return. And now over the last 3 years, my perspective is I want to get a higher CAGR, and I'm okay to wither a higher volatility for that. Now I'm at 22 CR, right? So the worst case is now 15. It depends on the market, but some amount of volatility. Let's say even if there is a crash, the portfolio goes down by 20, 30%, right? So then my lifestyle will not change. Right? I don't have big expenses coming up or lined up, right? Just go all in and try to make as much as possible. So yeah, that's what I'm doing for last 3 years.
Got it. So from 5 CR when you in 2019 to 22 today, that's a great compounding. What's your strategy? What's your investment strategy been in the last 5 years?
Yeah, same as I mentioned, I have fast growth cyclicals and special situations. So I did all three of the above. But to be honest, the portfolio was created gradually over the last 5 years.
Okay.
So it was not like day one I had invested everything into the market, and the market has been very kind.
Got it. Very exciting. The last 5 years, I think clearly. And you mentioned like now your day to day or the regular expenses are taken care of by the salary, and you are focusing on growing the corpus. What about emergency funds? Do you have any money aside in any other asset class which is more liquid compared to stocks?
No, no. So basically, I also take trades, and these are generally event-based trade, not like chart-based. So basically, for example, some trigger happened, some company had, and these are short-term trades, like 3 month, 4 month kind of trades, and they either make you like 30% in a quarter, or they lose like 10%.
Okay.
Right? So they come with a fixed stop loss where you have to cut it. So I would say 15-20% of the portfolio is where I park my money in these trades.
Okay, these are
which I-
futures.
These are not futures. These are cash market trades.
Okay.
But these are not long-term investment. I would not keep them for 3 year, 4 year, and try
Okay.
to tag along with the journey of the promoter or the owner
Okay.
of the company, right?
Okay.
Here, the thing is that, for example, some company got a big order. I know that
Okay.
it will go up by 30%, 40% just to price in the information arbitrage that it has.
Okay.
I try to get in on the first day and try to whatever I make 20%, 30%, and then I exit. Even though I do not believe in the company, I do not like the business model of the company. I do not want to stick around for the long term, right?
Okay.
But I know for a fact that these are certain things that play in the market, and this is pure information arbitrage. That
Right.
some information, when you are early or you try to catch them early, then you can actually ride that 30% kind of a arbitrage.
Okay.
Because it comes over a few weeks or a few days.
So it's just being opportunistic.
It is just being
there.
opportunistic there, yes.
Okay.
So your question on liquid funds,
Yeah.
these are short-term opportunities. Generally, they make like in a quarter, I would just exit. Worst case, if it is not, and it does not play out a lot of times. Sometimes, by the time you enter, the stock is already up 10%, 15%. Then it goes down and you are not confident to hold it. You take a 5%, 10% loss and you exit. Right. So I always have that 20% cash lying around.
Got it. Interesting. Given 22 CR is like a big portfolio, how do you manage in terms of monitoring the portfolio, rebalancing? What's your rebalancing strategy like?
I basically create a thesis of a company and say that, okay, this is what I feel will happen. And if the thesis is playing out and the company is delivering what I thought it was supposed to do, then you don't have to do anything. That sometimes leads to cases where some positions become very large. I'm okay to go up till 20% in a single stock.
Yeah.
Beyond that, it's kind of a little shaky for me.
If we were to summarize this section for the audience, right? What are the top green flags and red flags to look out for in a company?
Green flag obviously is the company is growing very fast. There is something the government is focusing on the industry, or some macro thing is supporting that industry, and there is a very less chance that a promoter can grow a company when there are headwinds. And by headwinds I mean when the government is against you.
And top red flags for a company.
So top red flag is the company is making a lot of money in terms of profits, but in reality, they're not making a lot of cash flows. That is a very, very big red flag for me. I do not invest in industries where the government wants something to go away.
Great. I think that summarizes it really well. I think the biggest takeaway is keep your eyes and ears open, as you said, and you look for all of these indicators, and then put your money there. For someone who is starting his or her investment journey and wants to dabble into stocks and make a calculated, bet here, what is your advice to a new investor?
I would say don't start concentrated. That was a mistake that I made. Unless you are confident enough that you understand the industry, start with like 30, 40 stocks.
Okay.
Slowly, as you gain confidence, slowly bring it down to, I think 15 to 20 is an ideal number.
Okay. Great. Shubham, this has been amazing. Thank you so much for taking out the time. We hope you liked the video. If you want to join our podcast and share your story, fill the form in the pinned comment.